great question. As you know, there's a lot of different people, camps, pools of capital that come into this from very different angles. So I think just right off the bat, it tells me and it shows people that if there's all these people coming from different backgrounds, walks of life, industries, education, political beliefs, whatever it is, if they're all coming and being attracted to Bitcoin and finding something interesting and of value there, I think that's a signal in and of itself. And as you said, institutional investors are just one of many. And so I personally believe you do have to have a fundamental understanding of Bitcoin. And this is something we can certainly talk more about, but you have to have some of that philosophical understanding to really get the investment thesis for Bitcoin and to have that conviction of making a long-term allocation. So putting that aside, one of the things I tried to do is also buttress that with the investment case. And that was the presentation you were just mentioning. So it was at Strategy World, Bitcoin for Corporations. And that's what I was trying to do there. I was saying, you have the investment thesis side, you have the philosophical side, but then here's something else. Here's another leg to add to the stool of the investment thesis. And that's speaking to institutional investors in their world, in their language. So putting it in terms of how does this stack up against other assets that you might be considering? What's the return been? What's the risk? What are the different ratios, Sharpe ratio, Sortino ratio, Kalma ratio? You can really nerd out on all of these like CFA level ratios and things. And then how to think of it in terms of risk, portfolio allocation size, rebalancing, all these things that an institutional investor thinks about as they go through any other of their investment decisions. Why not go through the same process with Bitcoin? And I personally think we're at the point in the cycle where before, or the point of adoption, I should say, not cycle, because it's more of a long-term adoption thing, where before institutional investors could have pushed Bitcoin aside saying, it's too small, it's too speculative, it's not worth my time. Now it's a $2 trillion asset class. You have multiple companies adopting it on their balance sheet. You have countries adopting it. You have regulations, specific regulation being formed around it. So it's gotten to the point where institutional investors need to have a good answer as to why or why not they are considering it or adopting it or not. Now, not to say that it still might not be a good fit for them, for certain institutional investors, but they at least have to have done some of the homework so they can answer it intelligently and in that institutional investor framework.
It's interesting because I hear a lot with traditional financial people that say risk is the same as volatility. You know, they put like if the asset moves a lot, which Bitcoin does, even less and less so, they're putting that the same as risk. How do you look? How do institutional investors look at risk and volatility, and how to assess the kind of risk that Bitcoin carries?
Yeah, so in traditional finance, in the CFA curriculum and MBA programs and whatever else, you will find risk is volatility. Volatility is risk. And that is how they measure it, and that is how they monitor it. And there's good reason for it. Let's not, poo-poo that and say like, oh, that's nonsense. There's a very good reason for that. And the reason volatility is risk in the institutional world, why it's the bedrock metric to look at and incorporate, is because most assets have a relatively normal distribution of the returns. So if you look at something like daily or monthly returns, it looks like a bell curve where you, on any given day, week, or month, it's going to go up a bit or down a bit. It's probably got, or at least hopefully has, if it's in something you're investing in, it has a positive mean. The average is positive, meaning over time it goes up. But when it goes down, it usually goes down very quickly and a lot. So there's more occurrences on that left side of that distribution. And so that's what they're worried about. And that's what they should be worried about, because normally when they've encountered higher volatility, higher standard deviation, again, this is just, simple mathematical statistical concepts. When that's occurred with traditional instruments, traditional investments, it's because they're going down. And so that's why they're so focused on volatility is risk and risk is volatility in their mind. It's one and the same. Bitcoin is incredibly unique. At least it has been historically. This is not to say this will continue in the future. But if you look at the return distribution of Bitcoin, it actually has more volatility on the upside, meaning when the standard deviation is increasing, when it's getting more volatile, it's because it's actually going up in price. Now, it has plenty of times when it's really volatile and going down in price as well, but there's more occurrences on the right. And there's really no other asset class like that. And one of the ways I simplify this, and I borrowed this from someone else's, so I can't take credit for it, but I think it's an excellent analogy. If you've heard of good cholesterol and bad cholesterol, not all cholesterol is the same, HDL, LDL. You want the good cholesterol, you don't want the bad cholesterol. Volatility is the same thing. It's simply just a measure of standard deviation around a mean. So it can be on the good side, the positive side, or it can be on the bad side. Traditional finance, it's almost always been on the bad side. Bitcoin has more instances or occurrences on the positive side. So it has more good volatility than bad volatility. And that's why for Bitcoin, volatility isn't necessarily risk. And the other thing, and I made this point in my presentation as well, is, and I think Warren Buffett and others have said this, true risk is permanent loss of capital, not volatility. So if you have a long time horizon and your ultimate goal is to increase your returns or have a positive rate on returns, what you're most concerned about is the risk of losing it all and losing it forever, for it becoming dead capital that you can never get back. So again, it's like, do you want something that is going, very stable? It doesn't move a lot, but it has the potential to either drop and never come back, or it has the potential to just slowly bleed out. Something like if you were to put your money in cash, the US dollar is slowly bleeding out from inflation. Or do you want something that has, over time, at least historically, a positive return? And granted, it's had a lot more noise in between, but all you care about is the beginning point and the end point. If you don't care what's in the middle, then your risk is not the volatility. The risk, again, is that risk of permanently losing your capital. So long-winded answer. Hopefully that makes sense. But that's, I think, a better, or at least a different way to look at it.
I love the comparison with good and bad cholesterol. I also heard, Saylor is, I think, the most prominent saying that volatility is vitality. And I don't understand the financial engineering that MicroStrategy and with all the products with Strike, Strive, and all the things he's doing. But I heard from a lot of people that love strategy and love what they're doing, that volatility is actually very good for their performance and from what they are doing. Is the volatility something that institutional investors are actually looking forward to using in different products, and like not just as buying and holding, but kind of playing with the volatility? I'm really outside of my expertise level here, but I've just heard strategy people saying a lot, you can really use it in a financial engineering environment.
Yeah, it's a great question. I'll put strategy aside and just talk more generically about this for you and other people who have these exact questions, which I've had to learn a lot about. Even someone immersed in this field, I've learned a lot more about this entire marketplace and market structure. On the one hand, there's a lot of pools of capital where they don't like volatility, and that will never change, right? Pension funds, retirement funds, people who need regular cash flows, they do not want volatility, and that's fine. There's other pools of capital that love volatility because they monetize it, or they trade it, or they sell it. If they're selling options, they're making money from the volatility. And so that's what some of these products do. They take advantage of that, and they open it up to other investor segments and pools of capital that like that, because that's their business and that's what they're good at, and that's what they do, and they control for it. So that's one of the reasons they might like it. And the other angle of this all is just the idea of a company that's dying, that's dead, is not getting much attention. And so it's not per se that you want the stock to be more risky or more volatile. You just want people to actually be paying attention to it. There's actually a huge, I don't know the numbers right off the top of my head, but the 80-20 rule, it's even more extreme in the financial markets. I used to be an equity analyst. All the equity analysts spend all their time on the big stocks. There's 20, 30, 40 analysts for companies like Apple and these big companies. There's very little to no analysts for the small cap companies. And they don't like that, right? Because then their stock and their story isn't getting out. They're not attracting new investors, and their stock just kind of remains dead in the water and doesn't sit there. So that's the other angle of why you hear this term of volatility is vitality. So I think people need to be careful about that term, because it's not one blanket statement that's true for everyone. It depends on who you are, what kind of investor you are, and whether or not you invite the volatility and you like the volatility or not. And so I think that's one of the distinctions that has to be made with that.
It's super interesting when you think about all those different rules, so like the 60-40 portfolio and diversification and all those things. And there's now those ridiculous new Bitcoin class coming in, like myself, that is just like all in Bitcoin. And I don't want to touch anything else currently. How do you think long term those portfolios and those traditional kind of like mindsets and approaches to portfolio management, but like personal finance and advice will change when the underlying currency is no longer inflating but kind of deflating, and we get more value? So kind of like you gain purchasing power by just holding the underlying currency, versus you lose purchasing power by holding the underlying currency. How does this change our perspective on traditional portfolio allocations and personal finance advice?
It's a great question. Yeah, it's fascinating to think about. Number one, we've been in a monetary era or regime of free floating currencies for 50 plus years now, since we officially severed the link to gold. And inflation has almost always been positive ever since. And so it's well understood in traditional finance that the whole goal of investing is not only to grow your capital, but at the very minimum, outpace inflation. And so that's why we always try to look at real returns. So your return minus your inflation rate, right? If you made 3% on your investment, but all the stuff you need to buy costs 3% more, you're only treading water, right? You got to keep up with that. And so this has always been a concept in personal finance and investment management for a long time. Where it gets interesting is what you said. People are questioning, starting to rethink the 60-40. That's also been a longstanding bellwether in traditional finance for a long time. And they're mostly questioning the 40 side, the bond side, right? So this was one of the points I made in my presentation as well. Companies and other big institutional investors, they're really only allowed to, for regulatory and company specific reasons, to invest in bonds, and usually treasuries, government bonds. Over the last 10 years, they've returned only a couple percent a year nominal. That's before inflation. And you look at something like Bitcoin or other things that have, or stocks even, that have these big drawdowns in price. But if you look at bonds, like the 10-year bond, there is a period where on a real inflation adjusted basis, you had a drawdown of 55%. So you look at just the nominal, the price of bonds, and it only draws, like the 10-year might have only drawn down like 5 or 10% at its very worst for a very short time. But if you calculate inflation into that, you were underwater on your bond investment for 40 years at one point. Which really blows people's mind. And again, this is why portfolio allocation is built around adding different things. So no matter what regime you're in, you will hopefully do well. You're prepared for any scenario. And that's why people are looking towards things like alternatives in general. We've seen a big trend towards all kinds of alternatives, which is really just a catch-all name for anything that's not stocks, bonds, or cash. So real estate, commodity, precious metals, hedge funds, art, whatever it may be. And now, of course, they're increasingly looking at Bitcoin because it has a lot of those same characteristics, potential asymmetric risk reward, but it's more liquid, it's more divisible, it's more verifiable. So it has some of those same characteristics as an alternative investment, but without some of the deficiencies. And so this is how, again, my job, bridging the two worlds, talking to institutional investors, one of the things we do is try to put this in that lens, say, hey, you've invested in alternatives before. These are the reasons you did it. Why not consider at least Bitcoin as falling in that alts bucket to try to make up for some of the things you've been losing on the bond side, for example?
Yeah, there has been really interesting calculations that I've done with some of my guests, saying, what if a pension fund is only getting 1% into Bitcoin and using that as and how much does this actually change the return the pension fund is doing? And just like adding 1 or 2% in it drastically changes the overall performance because this 1% performs so good compared to all the other things. It's kind of, you mentioned it, asymmetric. I think it's weird. I never asked that question, but it's a lot in Bitcoin conversations. What do you mean by asymmetric? I think you said investment or asymmetric. We also say a lot, Bitcoin is an asymmetric bet. How do you define that?
Yeah, so something that's symmetric would have equal on both sides, right? So it's like either equal probability it goes up or down, or equal magnitude of up or down. So it could go up 20% or down 20%. Bitcoin, at least historically, has shown a very asymmetric return profile. It's gone up more than it's gone down. And the times it's gone up multiple times more than it has gone down. So if a simple buy and hold of Bitcoin, the most you could absolutely lose is 100%. Whereas we've seen Bitcoin return over 100% just in 1 year. So that's what we mean by asymmetric, right? And this is what traditional finance people are very familiar with things like venture capital. Venture capital has a very asymmetric risk return profile. Most of their early stage seed companies go to zero. Some of them are kind of middle, they get their money back. And then they've got 1 or 2 10x plus companies that really hit a home run. And that's what they're looking for, right? Now, what's interesting when you get into the portfolio construction stuff is when you add something that's asymmetric like that, you can potentially increase your returns without increasing your risk if it's also not correlated to other things. And that's what we find too. So you mentioned, the little allocation goes a long way. That's what we've found in our research, both historically and using some other models as well. Just a little bit can go a long way. And most interestingly is that you can actually do better by rebalancing and trimming that back. And this is also where Bitcoin is very different than other asset classes. So because of that asymmetry, when it goes up really, really high, let's say you have a certain allocation, 2%, 5%, whatever it is. Those aren't recommendations, just as an example. But say I'm going to allocate 5% to Bitcoin. It goes up 100% in 1 year. You have an annual rebalancing process already built in. You trim that back and you sell it and you trim it back to 5%. You're actually harvesting that volatility. So you're actually doing better by trimming that back, reducing the risk, but still capturing those gains. Now, it takes a little bit of conviction that if or when Bitcoin goes down 70, 80%, you need to put more into it to rebalance back to your target. So that's a little harder to do than just taking those gains off the table. But if you do both of them in a disciplined way, at least historically, our research finds you do a lot better because of the unique asymmetry to this asset class.
Thank you for watching this video. This was only a snippet of the podcast. And if you want to watch the full episode and get all of the context of this episode, you can click right here or here. Oh, maybe also here.